What I'll do is just give you a brief background of what transpired last year from a geological and corporate point of view, and then also try to give you a sense of what's in front of us in 2018. I think it's going to end up to be a seminal year for the company. Last year we intended to drill 10,000 meters, and given the price of lead and zinc, we doubled that to 20,000 meters. We put our foot on the gas because I think one of the key tenets of Vendetta is that we wanted to capitalize on this portion of the zinc market. So just briefly, I'm 20 years mining experience on the investment and marketing side. Peter Valgaris is former technical services manager at Ivanhoe Resources, which is the giant Oyu Tolgoi project in Mongolia. He spent 5 years with Robert Friedland, ostensibly doing all the underground development, pre-mining. David Baker was a treasurer at Ivanhoe, raised $5 billion for the project, including $4 billion of debt. Doug Flegg is a former head of institutional sales mining for Bank of Montreal. And Doug Ramshaw is current CEO of a TSX venture-listed company, former London-based mining analyst. Just by a bit of a report card, to date we've raised $9 million for the Pegmont project, which is located in the Mount Isa district of Australia, and I'll get into why we were there in just a second. Just to give you a bit of background, there was previously $20 million spent on the project. There was 4.3 million tons historic of sulfides in inferred, with a further 700,000 in indicated. We believe we could take the ore body to 15 million tons and end up mining on our 10 million tons of our best ore, and that would give us the economic parameters we would need to put this into production. And it's changed somewhat since we originally had that thesis, and I'll also quickly take you through that. To date, the total meter drilled is 30,000. Our metallurgy, we didn't know what the metallurgy was initially. We thought it was going to be good. It's come back that we can produce a commercial concentrate on both lead and zinc, and that's paramount, I think, at the end of the day, to having an economic ore body. So that's a big box ticked off. Our metallurgy is good, and if anything, it's only going to get better. We have increased the resource by 75% on the inferred, with a 44% on the indicated. Expect to have an updated resource out within 2 months. We are trying to get it out for PDAC. It depends on our metallurgical work, our ongoing met work. If that comes back sooner, we hope to get it out in February, could be into March. We've also made 2 significant discoveries on the ore body, the Burke Hinge zone, which looks like it could be the zone that comes to the surface, so it could be our starter pit, which impacts the economics dramatically. And then the Bridge zone, which we discovered last year, looks like we're scoping out over 1 million tons there. That would be 100 meters from our open pits, and that would be the first area that we would go underground on. I think it looks like this ore body optimizes at about 1 million tons per annum. I'll just quickly talk. I know Eric talked to the lead and zinc price. I think even though we had the increases last year in lead and zinc, we didn't see the corresponding lift in a lot of the zinc companies and lead companies. And I think markets are very efficient, as Eric alluded to. The inventories are starting to approach some historic levels. The treatment charges and refining costs at the smelter level, which is always, to me, the canary in the coal mine, are almost all-time lows, which indicates that there's definitely the squeeze we thought was coming is here. This is the zinc market we've looked for since 2007. And it's important to us that we can take advantage of these zinc prices. And as I said before, we doubled our meters drilled last year to do so. And then going forward, I think we just need to tweak the ore body. And I'm often asked, are you guys going to sell it? Are you going to put it into production? We are capable of putting it into production. Peter Valgaris has led teams that have done this before. He's worked in the region. Oyu Tolgoi, one of the world's biggest mines, he did all the underground development, as I mentioned. We are capable, but if we receive the right offer, you know, as we like to say, Gretzky was traded. Anything is possible. And there are several. We have recently received overtures both in North America and Australia. There's just not a lot of good zinc lead projects out there, and I like to think this is one of them. really the key focus for us was always infrastructure. In order to take advantage of this zinc market, we needed to demonstrate that we could be in production relatively quickly. Now, we're looking at putting a PEA out either third quarter or fourth quarter this year, and I can talk specifically to economics, but in a broad space, if we can use one of the local mills at either Cannington right here, which is 25 kilometers away, or at Osborne Colthor, you'll be looking probably at a capex of only $50 to $60 million. We modeled this project on 90-cent lead and 95-cent zinc to give us a real good stress test. I'm not concerned that we'll get back to those levels, but I think most of us in the lead zinc space are of the opinion that when we do, as Eric said, if zinc does go up to $2, it probably won't stay there as additional production comes on. The second leg of this zinc cycle is what's the sustainable price going to be? And I think a lot of people are modeling at $1.10, $1.20. We wanted to build in an additional cushion. And just to talk to Cannington, they are on a declining grade curve. To make up for the loss of revenues, they're losing about 10% grade every year. They're looking at increasing the size of their throughput. They're currently mining on 3.2 million tons per annum. They're looking at going to 4. They're constrained by their shafts underground, so they're looking for an open pit. Our back of the napkin numbers would dictate that the Pegmont ore has twice the NSR value as the open pit portion of Cannington. So on paper, that makes a lot of sense. Osborne they're mining remnants now. I think they're out of production as of Q2 this year. So that's an obvious fit for our concentrate for our ore to go there. I can't comment whether we would toll mine it, sell it outright to them, or a combination, perhaps a joint venture. But I was recently in Australia. I met with both groups. We'll be having further meetings throughout the year. So they're definitely potential suitors. And there's some other local miners that are interested. The attractive part of Pegmont is I think we've essentially de-risked the project. Brandon just reminded me of something. I remember years ago I was talking to the CEO of a company called Falconbridge, which is now absorbed by Glencore, and I said to him, what's your definition of a world-class ore body? And I'm thinking he's going to focus on grade and size. He goes, no, Mike, it's nothing like that. It's so big and so rich that we can't screw it up. And that's Falconbridge. So I think I can stand before you and say, we've probably got enough ore now, and with our open pit component in Vendetta, I can't screw it up. But I will be able to quantify that in about 6 months when we come to the market with our PEA. So the advantages of where we are, it's in Australia, like Canada, like the US, it's a common law country. The infrastructure is phenomenal. The infrastructure's actually grown up around the project. It's got everything we need. We're about $1 million away for our haul roads. We've got electricity, got mills in the area. We've got access to a rail. We're a day away from the zinc smelter on the coast by rail. We're 4 hours away from the lead smelter at Mount Isa. Permitting, we're very fortuitous. The majority of our open pit falls on mining leases. We kind of joke, Captain Cook must have staked this project because you don't see many projects in Australia that have these grandfathered components. What it means from a practical point of view, we don't have to go through our Aboriginal permitting on this particular portion. So if we were going as a standalone, I think we could have this thing in production in about 18 to 24 months, 24 being more realistic. If we were using one of the local mills, 12 to 18, and we would be producing metal. We're just doing development drilling. We're adding to the existing. We're not doing large step outs. We don't need to. We're just filling in the blanks now and bringing more ore into resource, and we'll be doing that also this year. Deposit's completely open. I mentioned that we were hoping to get 15 million tons originally. I think we're almost at that level. The new resource will be out, and then arm waving that this deposit eventually could be 20 to 30 million tons. But the key tenet is we can demonstrate 1 million tons per annum for a minimum of 10 years, and I think we'll be able to do it through an open pit. Once again, de-risk. The economies of scale certainly work from that point of view. Once again, I mentioned all the infrastructure. We're close to everything. There's some local infrastructure. The picture on the right is actually Cannington, and then one of the advantages we have on this project, we can drive right to it. Our cost per meter is down to $210, which has allowed us to get a lot of tons per the budgets we put forth. And then we've got roads right to Osborne if necessary, which is the company owned by Chinova, which is out of ore. Our historic resource, we're currently looking at 8 million in the open pit inferred and indicated, with a further 3.5 million down dip, the underground portion. I expect that to increase in several months. One of the key things that we did this year on our drilling, though, we hit on about 75% of our holes in the open pit, but the grade was increased by about 25% on average for all the drill holes we put out this year. So what we originally did, we thought this was going to be an open pit. We hoped we'd find a little bit that we could, first year or two, to get our capital costs back. Or pardon me, we thought it was originally going to be an underground. We thought we could find an open pit component for a starter pit. When we put out the last resource in June, the majority of it optimized as an open pit. Now, the challenge that we had, and it's more of a marketing challenge, I think, for the company than it is a technical one. On the open pit, the lead ratio to zinc is 2 to 1. And as we go down dip, it inverts, and there's a geological reason for it. We get higher zinc than lead, and some people said, well, why don't you guys focus on the down dip component and demonstrate to the market that you've got higher zinc? Because, zinc is a lot sexier than lead, even though they kind of like Jehovah's Witnesses, they move in tandem. So what we came up with our own internal modeling, though, the value of that open pit ore, due to the processing costs and the fact that you've got a lead smelter within 4 hours by truck, far exceeds the value of the down dip ore, making it a lot more attractive to finance, to bring on stream quicker, and also for potential suitors, because we can demonstrate through the open pit component that we're economic quicker by having access to that open pit ore. So quickly, drilling highlights from 2017, as I mentioned. Our grades have gone up considerably. Most of the holes we hit were north of 10% lead zinc. I don't see that changing. We're now looking at a strike length on the open pits of 1.8 kilometers, 18 football fields long by 5 football fields wide. We'll be doing further work to tighten up those pits next year and then go to a PEA. Bridge zone, that's our first zone underground. It's 100 meters from our pit. We've hit some of the best grades at the bridge zone. It's 200 meters down. It would be the first area that's mined underground. The other challenge is on the underground ore. If we go to add a significant amount of the resource, it's going to be ore that's added now on years 15, 16, 17, 18. The net present value of that ore is diminished from the ore that we're finding on surface. The average depth on the open pit portion is 80 meters.
That little box detonates when you hit 4 minutes.
All right, there we go. Key catalysts. We'll have drill results out next week. Metal, I'm going to put you over just to piss you off. Metallurgical test work, sulfide. We've got further work on the way. The metallurgical test work on our transition zone is out in about 30 days. Look for that. That's a key number. If that transition zone, if we can produce a lead and a zinc concentrate, we don't put it in our financial model, we put it in the resource, it would impact the economics of the ore body greatly. We hope to demonstrate that you could get your CapEx back through mining the transition zone. And as I say, that's due in about 60 days. The fact that I'm telling you it's due in about 60 days, I expect it to be good. Second resource update's coming in a month or two, and then we're going to start our 2018 program. shortly. Just in April, our objectives are to expand the shallow part of the open pit. We're going to test the regional targets, and we're going to follow up on that copper hole that I talked about last year, 3 meters of 3%. I don't think we had the right geometry of the drill right. We're going to go back at it. We've got an 800-meter EM anomaly. It's worth following up on and test some of the other targets in the area. We're almost through our environmental baseline tests and our groundwater. We might not need to do that particular test, being that the water table sits under the open pit, and that's what we're focusing on. And then you're going to see the third resource update and the PEA of Q4 2018, and those numbers are the ones we're going to be taking to the prom. That's what we're either going to be economic on, put it into production ourselves. That's what potential suitors will also focus on. We're just outside the doors there. If you've got any questions, I'll be by the booth. Thank you very much.